our own David Faber reporting this morning that the company is targeting a lower valuation than expected ahead of its IPO. And this has just been savaged, this company, after its S1 came out, which, you know, had all kinds of flowery language about what kind of company they are, but also some concerns just about how the business model, to the extent that you can call it that, is going to work.
Yeah, absolutely. If David put it that the companies may have a lower valuation, that's incredibly polite. This is the market just flat out rejecting what it was brought, you know, the S1 that was brought, basically saying, try again. This is ridiculous. And so they will now go and come out with a totally new valuation. They've already changed some of the things that had yellow flags or red flags, like this $6 million purchase of the word "we" from the CEO. That's now gone. So basically,
they even added a woman, you know,
exactly.
So
actually
added some.
We're going to try again and bring it back. And to me, this is actually a good sign. Like, investors are showing a lot of discipline. 6 months ago, it was basically an IPO, place the order. Now it is, we're going to look at it closely. We're going to really think about the valuation. And if we don't like it, we're going to say no.
We should bring people up to date on what it is that we're actually reporting. Remember, the last round for this company was done at $47 billion. Of course, SoftBank is its largest single investor by far at roughly $10 billion at various stages along the way, but certainly far higher than what I'm hearing is a level at which there's still not a great deal of demand, which is $25 billion. So there is a question as to whether you're going to get down perhaps as low as $20 billion. Would that be possible? And then you do have to wonder with SoftBank's view of it as to whether that's something they can even want to stomach.
Especially given Uber, right?
Yes, with Uber and potentially at least paper losses on there, given where they've been. Or can you find some sort of significant investor to come in at a level to sort of help give confidence to the marketplace? That's certainly something else that we should keep in mind as a possibility here, as the underwriters and the companies sort of search for what the right place is for a company that is growing revenue very quickly, but growing losses also almost equally to what the revenue number is.
And I think what you're seeing with Uber, we learned from that, Lyft too, is these private investors are buying preferred stock. They have downside protection. No matter what happens to the valuation, the worst they can do, unless the company really goes bust, is get what they put in back. It's not that way in the public market where you're buying common stock. You can immediately lose half your investment overnight if things go south. So here the market is saying that's like we're not going to pay the same valuation you paid with your downside protection.
Ali, to that point, I mean, you could call this the ultra bear, I guess, case for WeWork as it gets ready to go public here. But when someone like Sam Zell, longtime real estate investor, one of the pioneers of REITs, comes on CNBC and says that he's seen this type of business model before for decades now, and that there's never been a case where a company like this has actually not gone bankrupt. I mean, you think what? Is there a sustainable long-term business model here, especially in a recession?
Yeah, you know, it's funny, when you mentioned Sam Zell, I mean, there's an open question as to whether WeWork should be considered a technology company at all. I mean, certainly they do some interesting things in terms of using technology to enhance their environment and workplace environment and product offering, but fundamentally it's a real estate company, and I do think we've seen models like this before. So, you know, I think, you know, Sam may have a point, but I want to underscore one thing Henry said, which is public market investors are valuing businesses. You know, I think this is good news because the public market is valuing businesses based on fundamentals. And the private markets sometimes get ahead of themselves in terms of real fundamental analysis of the business. And if fundamental analysis of this business indicates that it's worth less than the last private market investor paid, so be it. I think that's good news, and that kind of discipline is actually a positive, not a negative.
Henry, is there something going on here with valuations around names that have recently gone public? Can't help but think about Uber trading way below its IPO price. We're just talking about Livongo, which is down 22% this morning in its first report after going public. Slack, we were just talking about. Now, I mean, shaving some losses, but down about 7%. Does there need to be some kind of recalibration in how investors are thinking about younger companies?
I think you're seeing the recalibration. To Ali's point, too. 6 months ago, you just said, oh, an IPO? Buy. I'll take as much as you can give me. I'm guaranteed to make money. And then Uber came along and others, and we've seen, like, no, it actually really matters what price you buy it at. And that's what we're seeing. And that's what we're seeing with WeWork. And by the way, I don't mean to say it, like, if they come public at $20 billion, that is still an enormous valuation with enormous downside if things go wrong. So it's not like, so if we find a market at $20 billion, they're still doing great. And
Beyond
it's the same for Uber.
Beyond Meat's still worth more than $10 billion, though. So just let's not. Okay.